Good morning, good afternoon, and good evening to everyone. Welcome to today's webinar on global trends in deposit insurance, hosted by the International Association of Deposit Insurers. My name is Juan Lopez, and today I'm acting as the master of ceremony for this session that will bring together the IADI Annual Survey, but also from the Global Trends Report published in 2026. Today we will examine critical trends in deposit insurance, covering multiple areas, which will include the evolving mandates of deposit insurance, some interesting facts around the coverage levels, funding mechanisms, and the role of deposit insurance financial stability frameworks. So before we move on, allow me to introduce our distinguished panel of speakers. Some familiar faces for the IADI community, but those who are joining for the first time to an IADI webinar, let me introduce to Bert van Roosbeke, our Senior Advisor on Policy and Analysis, Mr. Nanjo, member of the Secretariat, and also Alberto Ortiz Torres, Associate. Before we move on, please allow me to share with you some housekeeping rules that are important for the development of this workshop. So if we can go to the next slide, please keep in mind that the views expressed are the speaker's own and do not necessarily reflect those of IADI members, or other members of their staff of the Secretariat. This webinar is being recorded, and the recording will be made available through IADI channels. So keep posted, we will be sharing this information shortly. After the presentation, we will have a moderated Q&A session. So please submit your questions using the WebEx chat function that you can find at the bottom right corner of your WebEx panel. So having these housekeeping notes covered, let's move to start. I'm pleased to invite Bert, Senior Advisor on Policy and Analysis, to the floor to kick off the session. So Bert, thank you for being here with us, and the floor is yours.
Thank you. Thank you very much, Juan. Thank you, everybody, for your interest in this work of ours and for joining this webinar. So we will be, in the next half hour or so, be presenting the findings of this Global Trends Report. But before we do so, let me take some minutes just to explain the input to this report. So where does the data come from that we have been using in this report? So as many of you may be aware of, IADI conducts an annual survey. We've been conducting this survey for more than 10 years, more than a decade now. So since 2011, to be precise. The very aim of this survey is to build a database of information on deposit insurance systems that is cross-comparable across jurisdictions. And I think it's fair to say that IADI has a unique data set on deposit insurance systems that reaches to the level of jurisdictions and deposit insurance. Maybe just to stress that the data that we hold and that we used here is largely data from members of IADI, but it also includes deposit insurers that are associates, or even some that are non-IADI members and that have participated in our annual survey. And we encourage all the deposit insurers globally to continue to do so in the future. Maybe just very quickly on the annual survey. So what we do is we simply ask something like 100 questions every year to a bit more than 100 deposit insurers globally, and we've been doing that for more than 10 years. So that gives you a bit of an idea on the wealth of data that we have there. The questions are very, very diverse. They span things like mandates, organizations of the deposit insurers, core elements of deposit insurance like coverage, funding, roll-in resolution, etc. And today we're just going to show you a subset really of that data that we used in the Global Trends Report. As I said, we gather this data on a yearly basis, so we typically run the annual survey in the third quarter of each year, and then we collect and validate data, and we publish this global trends report on a yearly basis in the first quarter. Last thing to say maybe on the data is that a subset of the data is included in a tool. You can see here in the last bullet, this tool that is called VIDA. So there's a Tableau-based visualization tool. IADI members can access this tool through our website, and this really allows you to use a visualization tool to analyze the data. You can compare different jurisdictions, and as I said, on a subset of the full data. So I think that's what I wanted to say at the outset, just to give you a fair understanding of what is the data that went into this report. On the next slide, this is just a global chart showing you where the data comes from, right? So every jurisdiction with a color here has delivered input data to our survey and to this report. This levels up, and maybe it doesn't look like it, but this levels up to 114 jurisdictions and deposit insurers. Some of the jurisdictions on the chart here have multiple deposit insurers in their jurisdictions. So 114. That's quite a number, and that includes 91 members, 2 associates, and 21 non-members. So I think it's fair to say that the report offers a truly global representative picture of the state of deposit insurance in the world. Okay, on the next slide. Just to give you an overview, so I will be talking about deposits and coverage of deposits, and then I will hand over to my colleagues, to Alberto, who will speak on mandates of deposit insurance and payout and non-payout resolution actions. And then my colleague Nan will talk on the funding of deposit insurance. So let me start with deposits and the coverage of deposits. So what this graph really shows you here, just as an introduction, is that we have 20,725 institutions that are a member of those 114 deposit insurers that took part in the survey. So that includes commercial banks and financial cooperatives. Those each span a bit more than a third of all the institutions that were reported on. And the remainder of that sample is really split between rural community banks, microfinance institutions, savings banks, credit unions, and other types of institutions. On the right side of the screen, you see some numbers on the actual deposits, right? So the volume of deposits by deposit insurers in our report, that was identified to be 29.5, so almost $30 trillion by the end of 2024. So just to give you an idea, this is about the size of the US economy, right? So that's quite a sizable volume of deposits. And the amount of deposits that are actually eligible for deposit insurance, that sits at 53.3 trillion, as you can see here in the green part of the right side of your screen. As a result of that, so the ratio of insured against eligible deposits, what we call the coverage ratio of all these insured deposits. So this sits at 54% of deposits eligible for deposit insurance. So roughly half of deposits globally that are eligible for deposit insurance are actually fully covered by and yeah, maybe just to finish off on this, so the actual number of deposits globally around the world, that would be the biggest circle here on the right side, that sits at about $85 trillion. So just to be, a word of caution that the definition of what actually constitutes a deposit, that's quite diverse globally. So that's a number that has to be taken with some caution. Okay, after this in small introduction on the state of deposits, maybe we can go to the next slide and speak about the significance of insured deposits over time. So let me remind you, IADI Core Principle 8 prescribes the deposit coverage to be limited and credible. This is to minimize the risk, of course, of runs on insured deposit-taking institutions without undermining market discipline. So the level and scope of coverage has to be set in a way that the large majority of depositors across member institutions are fully protected, but at the same time, it should leave a substantial proportion of the value of those deposits unprotected. This is, of course, related to market discipline. It's an important prescription from a financial stability point of view. So shareholders or depositors or any other creditors of banks, they in the end decide whether or not to fund a deposit-taking institution. And their decisions should reflect and also influence the risk-taking behavior of those institutions. And of course, they are supplemented by the responsibilities and the actions of prudential regulators or supervisors. But in the end, a skin in the game is something that is really important and necessary for depositors to exert this important disciplinary role in the market. So having said that, let's have a look at the evolution in the coverage ratio. So as I said, coverage ratio, that means the ratio of insured deposits to deposits that are eligible for deposit insurance. Maybe have a look at the left side of your screen on this chart here. This demonstrates that the evolution of eligible and covered deposits over time. So let me say that this is a consistent time series sample of about 73 jurisdictions. So it's not the full sample of the 114 that I referred to earlier on. So we did this to pick a more or less constant sample over time. We see that covered and eligible deposits have increased steadily until about 2020, and they are more stable in the years ever since. As I mentioned just before, insured deposits currently consist of about 54, so slightly over half of eligible deposits around the world. And if you read the report in some more detail, you'll find that this ratio has decreased steadily over the past decade, falling from 62% actually in 2013 to 54% in 2023 for this sample. If you look at the right side, the right panel shows you a bit of an alternative way of looking at coverage ratios. And this right side also shows some interesting regional variations. So this chart illustrates the evolution of coverage ratios, but it uses unweighted averages of coverage ratios by single jurisdictions. And as of the end of 2024, the average deposit insurer, if you want to say so, insures 42% of eligible deposits. So that means that about 2/3 of eligible deposits would be exposed to market discipline. So when you actually look at coverage ratios in this way, by using unweighted averages of jurisdictional coverage ratios, the decline of this coverage ratio that I just referred to is much less pronounced. Right? We also see some interesting regional variations. So particularly coverage ratios in higher income regions, especially North America and Europe. Coverage ratios in these regions are high, but they have been steadily declining in the past decade, from about 60% in 2013 to respectively 49 or 54% for these two regions in 2024. Contrarily, in Latin America and the Caribbean region, we find a relatively constant ratio. There is not much change over time there. And in Asia Pacific, there has been a recent declining trend, but that has been moderated in recent years by actually uptakes in several jurisdictions. Okay, if we move to the next slide, let's have a look not at the actual value of deposits, but at the people, at the depositors, right, and how exposed they are to losses on their deposits. So from a deposit protection point of view, recent decreases in the coverage ratio that I just referred to, deposit insurance system continue to fully cover a really large amount, a really large majority of depositors across regions. So, as you know, deposits by natural persons, they are universally eligible for deposit protection. What we also monitored recently is that the share of systems that protect non-financial, so non-bank companies or other eligible legal persons, that has actually also increased recently up to 90% in 2024. If we now look at these graphs in a bit more detail, you can see that the average deposit insurer fully protects 96% of eligible depositors, right? Or we don't have data, we look at the coverage of the actual account. But the main storyline here is that the protection is constantly very, very high at around 96% in the past decade. As I said, this level has not changed much over time, and it's tracked closely by the averages in regions like Asia Pacific and Latin America and the Caribbean regions. We find for the Middle East and Africa that the average share of depositors that are actually exposed to potential losses has fallen from 4 to 3%, and this is in part explained by the introduction of new deposit insurance systems. But these numbers are very, very low, so there is a very high majority of depositors that are fully protected. Okay, on the next slide, let's speak about the economic significance of deposit insurance. How do we do that? We do that by looking at the coverage level in relation to GDP per capita. This is a well-known metrics for looking at coverage. What can be seen on the chart here on the left side is that the actual depth of deposit insurance as part of the financial safety net, it has been mostly declining around the world. So in 2023, in 2013, so about 10 years ago, more than 10 years ago, the average coverage level was at 4.6 times the GDP per capita. And the latest figure we found in 2014, this shows that this coefficient has been reduced to 3.2. So we notice a global decline, but in addition, we also see that this trend has actually been observed across most regions in the world, and we see a convergence around this, let's say, roughly 3 times coverage across regions. We believe that the erosion of this coverage relative to GDP per capita can largely be attributed to economic growth and to the increase in price levels that we see, of course, in many parts of the world. And at the same time, this is coupled with a very infrequent adjustment of coverage levels, which are nominal, of course, in many jurisdictions. Just to give you an idea, and there is more detail on that in the report, throughout the sample period, we observed 26 deposit insurers that conducted 51 adjustments to their coverage level. 51 adjustments. We excluded those adjustments that are indexed, so semi-automatic, often indexed to inflation. And if you consider that in more detail, well, given that our sample has a bit more than 100 deposit insurers, this actually means that the rough frequency of a deposit insurer changing its nominal coverage level is just once in about 2 decades. Right? So this gives you a feeling of the relative stickiness of nominal coverage levels, which can explain for this decrease in the coverage level expressed in GDP per capita. So another thing that we noticed on the right side of the screen here, this is another pattern of deposit insurance coverage in relation to income, which is very non-linear, as you can see. So what we see on the right side here is that covered deposits as a share of eligible deposits are higher around the lower end of the high income bracket, right? So let's say between $10,000 and $50,000 US dollar GDP per capita here. Right? So this is what we see, that they're highest there, and then they actually decrease significantly on the very top end of the income category. So the extent insured deposits matter for financial stability. That shows some difference in relation to the level of economic and financial development in these jurisdictions. Okay, a last slide. We can move to the next one. The last slide on coverage. Again, let me refer to the core principles that say the coverage level should be set in a way to protect the large majority of depositors, of the persons, of the people, while leaving a substantial proportion of the value unprotected. So these two scatter plots here, what we really did is compare 2 years, 2013 on the left and 2024 on the right. And for each of the graphs, we show exactly those two things. So what is the share of depositors that are protected? That's the x-axis of those two graphs. And on the y-axis, this is the share of the value of deposits that is protected by the deposit insurance system. And if you compare both, you see a tendency of convergence. So the dots are closer together on the right side than they are on the left side. So we see a convergence, and we see that overall deposit insurance systems tend to be in the right place, right? There is a very high coverage of the depositors as persons, and a high, but not too high coverage of the value of the deposits. And I think it remains to be seen whether this pattern will remain valid in the future, given technological changes and newer business models of deposit-taking institutions, and of course any potential future policy initiatives. Okay, that's I think all we can say on, or all we will be saying on coverage and deposits right now. So let me hand it over to my colleague, to Alberto, and Alberto will speak on trends in mandates and in the payout and non-payout resolution. Alberto.
Well, thanks a lot, Bert, for these very interesting remarks, I would say, on coverage. And now, if we move on to the mandate of the deposit insurer, we would see on the first graph on the left side of your screen, we can see the evolution of deposit insurer's mandate over time. And here, let me remind you that according to the IADI core principles, the mandates can be broadly split into 4 groups. The first one is the paybox mandate, which is the narrowest type of mandate. And in this model, the deposit insurer is mainly responsible for reimbursing insured depositors. In the second mandate, we will have the paybox plus, and here the deposit insurer would perform the functions beyond a payout. And for example, it might contribute to the resolution decision-making process. It might support the resolution authority in carrying out its functions. And usually the most common thing that they usually do is that they authorize the use of the deposit insurance funds to support resolution measures. Third, we will have the loss minimizer mandate, where the deposit insurer actively engages in the selection and implementation of resolution strategies of insured depositors. And lastly, in the fourth group, we will have the risk minimizer mandate, where here the deposit insurer has comprehensive risk minimization functions that include risk management, a full suite of early interventions, but also resolution powers, and in some cases, prudential oversight responsibilities. Now, if we look at the chart, we see that it shows a clear global trend away from paybox mandates. In 2013, paybox deposit insurer represented almost 30% of total deposit insurers, and by 2024, the share has fallen to around 14%. This represents a difference of 15% in the share of deposit insurers. What we can also see in the graph is that at the same time, most of this transition has been towards the paybox plus model. Paybox plus mandates now account for roughly half of deposit insurers globally, and by contrast, we can observe also in the graph that the share of loss minimizers and risk minimizers has remained relatively stable over time. So mandate expansion is a well-established trend within the deposit insurance community, but we can more or less confirm that this expansion is mostly taking place through a move from paybox to paybox plus mandates, where there is a higher contribution from deposit insurer in non-payout resolution. Now, if we look at the second graph on the right-hand side of your screen, we can observe that mandates vary significantly across regions. Paybox mandates are still relatively common in Asia Pacific, in the Middle East and Africa, while, for instance, in Latin America and the Caribbean, we have that the most common mandate of deposit insurers is the paybox, where here it accounts for 50%. And also we observe that here the share of loss minimizers is the most prevalent across jurisdictions, with a 27% share of deposit insurers having this mandate. Next, in Europe, we observe that the most common mandate is the paybox plus. And in North America, we can observe that it's the only region where there are non-deposit insurers that have the paybox mandate. And we also observe that the most prevalent mandates is the risk minimizer mandate, with around 75% of deposit insurers operating under this mandate. So all in all, the overall global picture is one of expanding mandates, but we have substantial heterogeneity between regions. Now, if we move on to the next slide, we're gonna try to see another dimension on why deposit insurers move from one mandate to the other, because what we have observed from the previous graph is that we have a lot of deposit insurers that transition from a paybox to a paybox plus, and we would like to see if there is any insight at all with any factor that drives transitioning from one mandate to the other. Here we will only take a look at one factor. This factor is precisely the year in which the DI was established. So here we divided the deposit insurer in 3 cohorts that you can see in the vertical axis. We have the deposit insurers that were established. So the first group will be the one that was established before the Asian financial crisis. The second group, which is the second, will be the deposit insurers that were established during or after the Asian financial crisis, but before the global financial crisis. And then the third group will be deposit insurers that were established post-global financial crisis until today. This chart suggests that deposit insurers that have been established more recently are more associated with narrower mandates. For instance, if we take a look at deposit insurers that were established after the GFC, we will see that around 34 of deposit insurers have the paybox mandate, while 51% have the paybox plus mandate. All in all, this would account in an aggregate of around 85% of deposit insurers that we could more or less categorize in the narrower mandates. While if we look at the ones that were established before the Asian financial crisis, we see that here the loss minimizers and risk minimizers account for a total of 50%, which is half of the deposit insurers. Of course, this suggests that the more recently established the deposit insurer, the more narrower mandate the DI has. But even though this is an interesting pattern, we should interpret this carefully, because in this descriptive chart, we're not controlling for any other factors that might influence why a deposit insurer changes its mandate or why it has the mandate that it has today. For instance, one of those any other factors that could affect the mandate that the DI has today could be the development of the broader financial safety net or the context in which the DI was created. Now we're gonna move on from mandates to resolution, so that if we move to the next slide. If we move to the next slide, we have that on the first chart on the left side of your screen. We can see how deposit insurers' involvement in resolution has changed over time. The share of deposit insurers that have no input or responsibility in resolution has declined steadily over the last decade. At the same time, more deposit insurers are involved in resolution, either through resolution funding by contributing to resolution decisions, or in a smaller number of jurisdictions by acting as the sole decision-making authority. Overall, the proportion of deposit insurers that participate in resolution, which we interpret as being the ones that have the sole decision, contribute to a decision, or that participate in resolution funding, were around 67% in 2013, and now in 2024, it sums up to 82% of deposit insurers. At the same time, the share of deposit insurers with the sole decision-making authority in resolution remains limited and stable. It's currently at 8%, and this speaks also to the importance of coordination between financial safety net participants in the resolution process, which is an issue that received considerable attention in the recent review and update of the IADI core principles. Now, if we move to the second chart on the right-hand side of your screen, we look at the relationship between resolution and formal agreements with other safety net participants, if there is any relationship at all. Usually, these agreements can take the form of MOUs, which are memorandums of understandings, or other formal cooperation agreements. Their purpose is to establish clear frameworks for cooperation and information sharing before a crisis occurs. Now, what we look into this graph on the right-hand side is that conditioning the role in resolution of the DI, what is the likelihood that the deposit insurer has a formal agreement with other safety net participants. And what we observe is that the higher, you allow me to say, the role in resolution, we would say that there is a higher likelihood of having signed an MOU with another safety net participant. However, one interesting point that we also see from this descriptive chart is that among deposit insurers that are involved in resolution funding but have no decision-making powers, 28% do not have formal agreements with other safety net participants. Of course, depending on the jurisdiction, this might have implications for the early involvement of the deposit insurer when its funds may be used in resolution. This relates to the core principle 16, but it could also be related to core principle 16, where it could have implications for cooperation, coordination, and information sharing within the financial safety net. Of course, we see that here that 3 out of 4 of deposit insurers have signed an MOU or other formal cooperation agreements, but the existence of a formal agreement is just only one part of the story. It's also important to look at the content, quality, and effectiveness of these arrangements in practice. In particular, this is now being subject to ongoing analytical work within the IADI Resolution Technical Committee, where there is work on the interaction between the deposit insurer and resolution authorities, particularly in relation to information sharing, cooperation, and coordination. So we can conclude that deposit insurers are becoming more involved in resolution, mainly through contributions to resolution funding, but also as this involvement increases, coordination with other authorities becomes even more important for the orderly resolution of insured institutions. Now we will move on to reimbursement. So if we move to the next slide, we can see that reimbursement is at the core of deposit insurers and is the main responsibility of all deposit insurance systems. If an insured deposit taking institution fails, depositors need to regain access to their insured funds quickly. This is essential not only for depositor protection, but also for financial stability implications. Core Principle 15 states that most insured depositors should be reimbursed within 7 working days, and the revised core principles also introduced an aspiration for insured depositors to regain access to their insured deposits as soon as possible, but within 3 days of reimbursement being triggered. So now if we move to the chart, we will see that on the first graph on the left side of your screen, we can see the distribution of the number of days needed to begin reimbursement over time. And here we have 5 buckets. Depending on the time that it needs to start reimbursement, we have between 0 and 3 days, between 4 and 7 days, and then we have buckets for deposit insurers that take between 8 and 10 days. Then we have the 4th bucket between deposit insurers that take time to initiate reimbursement more than between 21 and 30 days, and then more than 31 days. We can see that the improvement over the last decade is remarkable because in 2013, around only 33% of deposit insurers started reimbursement within 7 days. And by 2024, by the latest annual survey, this share had increased to around 70%. we can see that at least the time to begin reimbursement is becoming faster. At the same time, the chart also shows that challenges remain, because we can see that around 30% of deposit insurers still report reimbursement timeframes that are beyond the international guidelines that IADI recommends, which is more than 7 days. So we see that meeting the international standard remains a challenge for some deposit insurers, and this is why reimbursement continues to be an important policy area for IADI. And in this context, we have the Reimbursement Technical Committee, which is also undertaking work on updating the 2012 guidance papers on reimbursement, so that the guidance remains aligned with the revised core principles, and so that also best practices are incorporated into the guidance paper. This is all to facilitate timely and efficient reimbursement processes. Now, a natural follow-up question is whether this improvement in time to initiate reimbursement has taken place across all regions, or whether we have that some regions are lagging behind. This is what we see on the second graph on the right-hand side of your screen. And here the chart compares the median number of days to begin reimbursement in 2013 and 2024. And here we split by region. We see that there is substantial progress across all regions. For instance, in the Middle East and Africa in 2013, the median time to begin reimbursement was of 33 days, while now it's of 6 days. And we also see that this improvement also happens in Latin America and Caribbean, in Europe, and in Asia Pacific. And for North America, we observed that it was already very fast in 2013 and remains at a median of around 1 day. So overall, the of any region systematically lagging behind in terms of the direction of improvement on the time to initiate reimbursement. Now, if we move to the next slide, we could have the question of what appears to support faster payouts. Of course, reimbursement speed can depend on many factors, but on this slide, we will focus on one specific factor: whether the time the deposit insurer gets access to depositor records is associated with faster reimbursements. So now let me remind you that the IADI core principles state that in order to reimburse depositors as soon as possible, the deposit insurer has access to depositor records at all times. Necessarily, this means that the deposit insurer should have access to depositor records before a failure occurs. This chart, we compare two groups of deposit insurers. The first group has access to depositor records before failure, while the second has access to depositor records after the failure of an IDTI. Here, the descriptive evidence suggests that access to depositor records prior failure is associated with faster reimbursements. For deposit insurers that have access to depositor records before insolvency, around 38% can begin reimbursement within 3 days, while those that only obtain access after insolvency, the share is lower, which is at around 28%, which is a difference of 10%. If we look at the 7 working days benchmark, visible, around 72% of deposit insurers with prior access to depositor records can begin reimbursement within 7 days, compared with around 64% that only obtain access after insolvency. So here, the main message, or the main takeaway, is that access to depositor records before failure appears to be associated with shorter reimbursement timeframes, which is in line with what the IADI core principles state. Now, let me conclude here and pass it to my colleague Nan, that will speak about funding.
Right. Yeah, thanks. Thanks very much, Alberto and also Bert. Following the discussion, let me switch to funding. The reason why deposit insurance systems require funding, this has been very well covered. In crisis times, we need funding to reimburse depositors or to contribute to resolving failing institutions. In ordinary times, a credibly funded deposit insurance system bolsters market confidence and also reduces the risk of bank runs. Most explicit deposit insurance systems develop funding on an ex-ante basis. This means that they collect premium from the industry and invest the contributions to ensure the system has sufficient readily available funds to deliver on its mandates. In addition, we will require funding mechanism. This is important just in case that the deposit insurance fund proved to be insufficient or not liquid enough to meet the need for financial stability. In very extreme cases, backup financial support may involve the industry or other financial safety net participants. However, it is important that the responsibility of funding lie with the member institution of the deposit insurance system instead of the taxpayers. So after this general framing, we want to show you a set of charts. The first one on the left, this illustrates the notional amount of financial resources at the disposal of deposit insurers. Here for the time series, we have 85 participants responding to our fund size question consistently through the years. The total fund size reached $404 billion by end of 2024. This is up from about 150 billion in 2013 and 300 billion in 2018. Right? So we can see there's a slowdown in funding growth in the more recent years. Also from the chart, we can see that North America, this is at the bottom, light blue, Asia Pacific, dark blue, Europe, dark green, remain the top three regions. Altogether, 350 billion from the. And if we compare between 2013 and 2024, we can see there's a shift in the regional composition of deposit insurance fund over time. In preparing for the report, we also tried to detect if there is any variation according to the mandate of the deposit insurer. We haven't found any material changes. From the chart on the right, we can see that paybox and loss minimizer deposit insurers each hold about a quarter of deposit insurance fund resources. The rest are mostly concentrated with risk minimizers. The share of paybox is quite small at less than 4%. Now, if we move on to the next slide, please. So another way to look at fund resources would be to compare them against some measure of contingent liabilities of the deposit insurance system. For example, we could divide the notional amount with the volume of cover deposits for each deposit insurer. This would give us what it was called the fund coverage ratio in some of the earlier work by IADI. So that is deposit insurance fund over cover deposits. Here on the left side, we can see the median of these fund coverage ratios across the regional groups. The global median has fluctuated around 2 to 2.5% around the time horizon. This is the thick yellow line. By end of 2024, this level reached 2.5% of cover deposits. So in other words, half of our deposit insurer participating into the survey has higher than 2.5% of cover deposits as resources, and half less than this. When we zoom in onto the regional trends, actually the first thing we discovered is that there's a lot of disparity all across. We had to actually plot two of the regions on the secondary axis to the right. So that is Middle East and Africa, and also Latin America and Caribbean. These are in the dotted lines. In Europe and in America, so this is green and light blue, what we noted is that this fund coverage ratio has stabilized for quite some period. At the same time, for Asia Pacific, this is the dark blue line, and also Latin America and Caribbean, this is the dotted green line. There have been quite steady increases, even including the recent years. For Middle East and Africa, the level was quite high in the beginning, maybe around 18%. We have to read this against the right axis. Now it has declined somewhat with the current level at 11%. So this would have to do with the introduction of some newer deposit insurance funds, and they have to begin collecting funding from zero. On the right hand of the slide, I want to point out that the fund coverage ratio also tend to decrease quite significantly as the income increases for the jurisdictions until the very top end. So this in a way relates to the U chart Bert was mentioning as part of the coverage discussion. And here it's hardly detectable, but for the very high level above $70,000 per capita income, it's actually quite slightly higher compared to 30, 50, 50, 70 US dollar per capita income. So this, in a way, is another way to look at the regional picture we have on the left side. So top, please, next slide. So we may be asking ourselves, okay, the funds are growing. It's a bit growing slower than before, But is this, sufficient, or is it all too much for the deposit insurer to handle a financial crisis, right? This is a very complex question, in fact, since the answer really would depend on multiple structural factors. We do not attempt to address these factors directly in the global trends report, but I think it's important for us to look at what is more commonly used as a target fund size. That is a policy decision to anchor the buildup of financial resources for deposit insurers. On the left side of the panel, you can see that, again, there's quite a lot of variation in how much deposit insurance funds are aiming to achieve. The level is the highest for Middle East and Africa at a really considerable 21% of covered deposits as a target. This goes down to a still very relatively meaningful level of 6.6% for LAC, 4.3% for Asia Pacific, and for North America and Europe, the median level are 1.3 and 0.8%. The right-hand side of the slide demonstrates the funding gaps from the target level. Again, the gaps are most obvious for Middle East and African region. This is a -4% of covered deposits as a gap to target, and the gap reduces to around 1% for LAC, Asia Pacific, and almost nothing for Europe. So we know that, in fact, most of the funds in North America and Europe have already achieved the target level from this chart. Perhaps a side remark, as I alluded to earlier, the target and gaps, they must be interpreted in the context of the underlying target fund size methodology. And there's quite a lot of variation in how they are determined. We'll be happy, of course, to allude to some of this in the Q&A discussion. But in interest of time, let me move on to the next slide, please. Yeah. Okay, so we covered on the stock of financial resources. Now let's take a quick look at the flow. So this is in terms of the premium that is assessed from the industry. What we primarily focus our attention on is the modality of premium assessment. Traditionally, the premium are collected on a flat rate basis. So that means a percentage is levied on an assessment base. This could be defined as a covered deposits or another contingent liability measure for the deposit insurer. But the problem or potential issue here is that the riskier banks and less risky banks, they contribute with the same intensity. And so this may raise some question as to the risk-taking incentives of these institutions, which supervisor and market participants will have to somehow counteract. So one way to mitigate is the introduction of risk-based premium. This could help mitigate moral hazard and also enhance fairness in the deposit insurance system. So on the left panel, we see that the proportion of deposit insurer collecting flat rate contribution have decreased from 57% to 38% between 2013 to 2024. So in other words, about 3/5 of deposit insurer, they now collect premium on a differential basis. On the right panel, we see that the prevalence of the system are relatively low for paybox, at 32%, but this really ramp up quickly to Paybox Plus, loss minimizer, and also risk minimizer function. The corporate scope does provide some requirements for differential premium systems to be implemented, and one can argue that the more mature or sophisticated deposit systems may be in a better place to be able to implement. This concerns the funding arrangements for deposit insurer, specifically relating to the public backstops. So this is next to the industry-funded backstops, for example, through extraordinary levies or prepayments, etc. So the resources from the financial safety net. Such backstops are quite important for the credibility of the deposit insurance systems in major crisis, because really no deposit insurance system would be designed to handle arbitrarily large financial crisis, since that would involve locking up a lot of financial resources from the industry, which affects the intermediation of these resources for economic activities. So oftentimes the systems really are designed with idiosyncratic and non-systemic crisis in mind. So in practice, the backstops may be implemented via, say, loans, guarantees, or other financial instruments. Typically, this will be at the discretion of authorities, and they may be subject to certain pecking order rules. For example, whether this can go, in parallel or only after market-based solutions, the cost of the payment would have to be borne by member institutions of the deposit insurance system. Our survey indicates the main counterparts of the backstop arrangements. So they are the government, Ministry of Finance, or the central bank, or in some cases, more commonly from international financial organizations with a sovereign guarantee, or through development banks. Here we can see that now 74% of the deposit insurer, they have the legal option, not the right, to access public backstops from either the government or the central bank. So it seems that the increase mostly happened vis-a-vis the central bank as a counterparty. So here we can see that the proportion of deposit insurers having this option is 43%. So when the situation calls, it's really important for the authorities to have agreed on the terms and conditions of such backstop, and establish a credible plan to replenish the deposit insurance fund with a view to the impact on the industry. So it would have to be flexible and disciplinary at the same time. So what I want to leave as a concluding remark is that a high level of crisis preparedness, as well as coordination, cooperation, and also information sharing across the financial safety net would be essential in mobilizing finance for the deposit insurance fund in a crisis situation. So yeah, that's more or less what I want to cover on funding. So let me pass back to my colleague Bert on some concluding remarks.
Yes, thank you. So if you can move to the next slide, please. It's a lot of information, of course, and more details in the report. Just on a high level, just 5 key takeaways maybe. So on the mandates, as Alberto said, we found continuous proof of expansion of the mandates. Most of the change we see is from payboxes in the direction of paybox pluses. This is related to the role of deposit insurers in resolution, where we see most of the movement in the financial support to non-reimbursement resolution cases and the involvement of deposit insurers in there. Talking about reimbursement, we concluded and saw quite some improvement in the speed up of reimbursement processes, and some evidence that this is related to earlier access by deposit insurers to records at the member institutions. On coverage overall, a finding of stability and of convergence towards a common level of coverage, at least measured in GDP per capita. And on funding, as just explained, approaching target levels, especially in advanced jurisdictions, and a higher relevance of differential premium systems and public backstop options. So we'll leave it there. Hand it back to you, Juan, to see if there is any questions that we can help out with.
Thank you very much, Bert. I don't know if you have noticed, but we place them in alphabetical order. So thank you, Alberto, Bert, and Nan, for this detailed presentation and for the insights that you have shared with us. And allow me to congratulate you for this work. I'm confident that we'll have more chances to discuss these very interesting findings, not only about this report, but the future ones that are coming ahead.